Good evening, everyone. I'm 𝗍𝗃 from FSMOne. So welcome to this evening webinar, FSM MAPS, positioning for the opportunities to come in 2024. So 2023 continued to be a rocky year for investors. At the start of the year, things seem to be picking up, and perhaps this time it is different. But no one expected the collapse of several financial institutions, sending the market into a turmoil again. A late rally in the last quarter, sent everyone entering 2024 on a high, although it remains to be seen if this is a sustainable wave. Nevertheless, I'm privileged to have Tan De Jun, Portfolio Manager of Research Team, iFAST Singapore, who will, over the course of tonight, walk us through 2023 and share with us investment opportunities that we can capture in 2024. In addition, he will also be sharing a couple of points from our 2024 investment outlook to help you face the year ahead better. So if you have any questions along the way, feel free to put them in the Q&A box below, and De Jun will get to them at the end of his presentation. So without further ado, let me pass over to De Jun to start the webinar going. De Jun, please. Wait, you are on mute, De Jun.
Okay, hi everyone, and welcome to tonight's webinar. So my name is De Jun, and I'm from the research team, and I'll be sharing some of the latest updates for our FSM. So just last week, we actually made a couple of major changes to our portfolios, and I would like to take this opportunity to share what they are and also our rationale for implementing them. But before we get to that, let's do a recap of markets and our performance figures for 2023. Right, so 2023, it was a surprisingly good year for markets in general, with both equities, for both equities and fixed income. So as you can see over here, global equities measured by the MSCI AC World Index gained 21% over the year in Sing dollar terms. So the gains were slightly lower in SGD, as the USD actually depreciated by the Sing by about 1.4%. So in the US, the S&P 500 index ended the year nearly 25% higher, which reversing from a near 20% slump in 2022. So the strong performance of US equities, it is mainly powered by growth stocks, such as those from the tech sector. And within the tech sector itself, we have internet companies whose share prices have risen by close to 60% on aggregate, and also semiconductor companies, which did even better with returns of close to 71%. So the gains, they were driven by a mix of factors, including structural drivers such as AI, and also a change in market sentiment as more investors, they started to anticipate a soft landing and for the Fed to cut rates in 2024. And not only that, stronger than expected earnings and also a fall in treasury yields in the latter half of the year also drove markets higher. So Japanese equities, gauged by the Nikkei 225 index, returned close to 20% in 2023, with local currency returns even stronger as the yen fell against the Sing dollar. So Japanese equities, they continued their stellar run in 2024, with the index closing in at an all-time high. So the outlook for Japan, it still remains favorable as it continues to benefit from tailwinds such as the return of inflation, which should result in positive shifts in consumption and also investment patterns, and that should help to spur growth. So change is also on the horizon in terms of corporate governance, with many companies now motivated to enhance shareholder returns. Long-term corporate profitability will also be boosted by companies as they seek to enhance their capital efficiency through investments. And last but not least, we also think that the normalization of monetary policy in Japan, it is also expected to increase the attractiveness of Japanese equities to foreign investors. But China, on the other hand, it continues to disappoint. With China bucked the trend and declined by around 12%, whereas most of the major equity markets were in the green. So China's reopening rebound has largely faded. The country, it faces a host of problems such as fragile investor confidence, record youth unemployment, deflation, and also a property crisis. And aside from this, there are also longer-term structural factors to worry about, particularly its embrace of top-down state-controlled growth model and shifting geopolitics, such as the deterioration in US-China relations. So all in all, our outlook for China is that it is in a structural decline, and in the absence of any significant reforms, any quick turnaround for the markets are unlikely. Now moving on, fixed income markets, they also had a strong showing in 2023, with the Bloomberg Barclays Global Aggregate Index gaining 5.7%. And as a matter of fact, most segments of the fixed income market actually recorded positive returns in 2023, but that was not achieved without volatility. So the 10-year US Treasury yield, it rose as high as 5% before falling to as low as 3%, all within a span of 3 months, which is the latest quarter. So bonds tumbled for the first 3 quarters of the year before subsequently recovering. And aside from falling yields, credit spreads, they also compressed given the growing expectations of a soft landing and also the better than expected economic data, which led to higher returns for fixed income markets in general. Now, moving on for our portfolios, starting with our growth portfolios, we delivered returns of between 5.7% and 11.4%. So relative to our benchmark, our returns were weaker due to a number of factors. So the first reason is because of US exposure, which is significantly lower than the benchmark due to our GDP weighted methodology. Now, as I've mentioned earlier, the US, it had a strong run towards the end of 2023, which led to a wider difference in performance between, especially for the more aggressive portfolios. So just to give you some color, the percentage of US that we have in our portfolios, it is around 30%, whereas for the index, it is around 62%. Now, the second reason is China. So even though we have trimmed our China exposure significantly since the end of 2022, it still represents about 11% of our total equity exposure. So this includes the core China allocation as well as the China allocation from the Asia ex Japan sleeve. And right now, like I said, it currently represents around 11%, whereas in the benchmark, it is only 2.6%. So poor returns from China also detracted from the returns of our portfolio. So in September last year, we also took a larger position in the digital economy, namely the internet companies and also semiconductor stocks. And those two sectors really helped to boost returns. So at the same time, we have also further underweighted China, which helped to avoid some of the drawdown in the last quarter of 2023. Now, for the fixed income side, higher allocation to short duration bonds relative to global bonds, which had a longer duration profile, also led to relatively poor returns in the latter half of the year due to a sharp fall in yields. Now, moving on, for the performance of our income portfolios, things are more or less the same, with returns of between 5.1% and 10.9%. So the reasons for the underperformance and the overperformance, it is same as the growth portfolios. So I'll move to the next slide, which shows our MAPS portfolios versus the various multi-asset funds that you can find on our platform. So this is sorted by year-to-date returns. So total returns across 2023 in Sing dollar terms. So as you can see, our portfolios, even though they are not the top, but I don't think they're the worst as well. So for our aggressive portfolio, it is actually ranked number 3. And yeah, so the portfolios that are highlighted in red, those are our 5 portfolios across that we have in MAPS. So moving on to this slide over here, so it shows you the same data in a graphical form so that you can visualize our performance better. Now moving on to our performance for the developed market equity funds. So generally speaking, growth, it outperformed value across most markets given the recovery in investor sentiment following the greater expectations of a soft landing and also for Fed rate cuts. And I think you can see this very clearly in the latest quarter. So if you look at the 3-month column, you can see that the majority of the growth-oriented funds actually outperformed their value counterparts and even the benchmark indices in some cases. So growth-oriented segments such as internet companies and semiconductors also rallied strongly. Now moving on, as for our emerging market equity funds, most of our Asia ex-Japan funds, they were in the red due to their sizable exposure to Chinese equities at around 30%. So China, as I've mentioned earlier, has been a drag on performance, and we look to trim China even further, even after all these adjustments that we have made across the year. So among the 3 Asia ex-Japan funds that we have, the one from Fidelity had the strongest performance year-to-date, rising by 5%, whereas the First State Dividend Advantage and also the Shoulder Asian Growth had negative returns. And the reason for Fidelity's outperformance is because it has the least exposure to China and Hong Kong equities, and also sizable exposure to chip makers TSMC and Samsung, which is its largest and second largest constituent based on its latest fact sheet. And like I mentioned, semiconductor stocks, they have done really well over this period, and that has also added to the returns for the Fidelity Asia Pacific Fund. Now, moving on to our tactical ideas. So the notable outperformer here is definitely the BlackRock World Financials Fund, which returned around 26% across the year. So most of the growth actually came in the final quarter of 2023. And despite the fund's exposure to defaulted regional banks earlier in the year, such as your SVB and the Signature Bank, it still managed to outperform its benchmark. So I'll just share a couple of reasons for this fund's outperformance. First of all, it is the good income figures by the banks. So the bank's net interest profit, it grew significantly, benefiting from expanding net interest income. Second reason is that investors, they are probably pricing in rate cuts in 2024. And with rates staying high for too long, it can actually hurt loan demand and may pressure banks to raise their deposit rates that they pay to customers. So it is actually beneficial to the banks to see some moderate rate cuts. And also, better than expected economic environment is also good for asset management firms whose core business is deal making, such as your fundraising, M&A, IPO, so on and so forth. Now, moving on to our fixed income funds. So our short duration bond funds, they have done relatively well with returns of around 4.3% on average across the year. While short duration bond funds, they have been a reliable source of returns over the year, their performance in the recent months has actually been overshadowed by the other fixed income segments, such as your global bonds, emerging market bonds, and even high yield bonds, as yields fell drastically, coupled with a compression in credit spreads. And that actually led to greater returns for these segments. But I would say for income of around 4.3% across the year, I think it's still decent, even though it is underperformed the global bond benchmark, which is around 5+% returns. I think 4.3, it is still relatively decent given the kind of environment that we are in. So moving on to some of the portfolio changes, here is a full list of changes that we have implemented across 2023. I think most of you guys have probably seen this before already, so I won't repeat all of them, but instead I will skip over to the changes that we have made last week, which I think is the reason why most of you are here. So during last week's rebalancing, we actually made a total of 3 changes to our portfolios. The first is to increase our equity allocation from underweight to neutral. So previously, all our portfolios, we were underweight equities by 2.5%. We have decided to bring this back up to neutral. And right now we have a neutral allocation for both fixed income and for equities. And secondly, for equities, we have decided to equal weight our value and growth allocations. So previously, we have we had 70% allocation to value funds and 30% allocation to growth funds, but we have decided to bring this back up to 50-50. And for the third change that we have made, it relates to the fixed income segment, where we raised our EM bond exposure from underweight to neutral in exchange for a further underweight in Asian high yield bonds. Now, so starting with the first change, we have turned more positive on equities due to our expectation of a pickup in corporate earnings, led by sectors such as the digital economy and semiconductors. We believe that these sectors, they have already been through a recession last year and are both currently on the path to recovery. And I'll be sharing more about our outlook for the digital economy and semiconductors later on. So even after enduring one of the most aggressive rate hiking campaigns by the Fed, the US economy, it continues to demonstrate its resilience, raising the hopes of a soft landing. So if you look at recent economic data, it has held up surprisingly well, and the likelihood of a US recession, it is starting to diminish. And if you look at advanced estimates, it shows that the US economy actually expanded by 3.3% in the fourth quarter of last year, which is much better than the forecast of a 2% rise and also a 4.9% gain in the third quarter. And with a resilient labor market, consumer confidence, it remains high. Consumer balance sheets, they are also much stronger today, given that the majority of consumer debt, roughly 70%, is in the form of mortgages. And most mortgages in the US are actually on fixed rate terms. So even though in Singapore, we also have fixed rate mortgages, but I wouldn't call them true fixed rate, because in Singapore, the rates are only fixed for maybe 2-3 years. And after that, you have to refinance at another fixed rate, which will be at the prevailing interest rate. Alternatively, you have to switch to a floating rate. So the fixed term is actually just for the initial part of the loan. But the market in the US is actually very different. So if you are able to lock in a mortgage at 3%, which was, I think, the mortgage rate after the 2008 global financial crisis, you pay that 3% for 30 years. So because of that, consumers, they are less sensitive to interest rates as well. And another interesting fact about the US market is that the majority of the mortgages there, majority, I mean 90%, they are all on fixed rate loans, and only about less than 10% they are on floating rate. So this is also very different compared to pre-COVID, pre-GFC times, where close to 40% were on floating rate loans. So for the US, aside from consumers, corporate balance sheets, they are also much more resilient than before. So most of the corporate debt in the US actually carries an investment grade rating, which also means that the interest expense, the increase in the interest expense, it should not be significant even with higher interest rates. Moreover, many of these US companies, they have also made use of the pandemic to refinance their debt at lower rates and for longer durations, thus reducing the need to refinance them in the near to medium term. So overall, we think that the US economy, it has become less sensitive to changes in interest rates, and that actually lowers the risk of a recession, especially in this higher for longer interest rate environment. But I would say that even if a recession does occur, it does not derail our positive outlook for sectors such as the digital economy and semiconductors. So that being said, while we are starting to turn more positive on equities, we are not advocating an aggressive all-in approach on equities. We are not asking you to sell out of fixed income and just buy equities, especially considering that the economy is probably in a rolling recession, where it suggests that some sectors might be going through a downturn, whereas other sectors like digital economy and semiconductors, they have already been through a downturn and are currently on the path to recovery. Moreover, another thing that I would like to point out is that equities, they remain expensive relative to fixed income, as the spread between the earnings yield and bond yields, it is still at one of the narrowest points since 2007. Now, moving on to our second change, which is on the fixed income side. So the second change that we made was to increase our allocation to emerging market bonds from underweight to neutral. That is from 7.5% to 10%. So EM hard currency bonds, they continue to offer attractive yields relative to history. The yield now is around 7.3%, and historically the yield has been around 5.6%. And at the same time, EM hard currency bonds, it also offers a generous pickup over US Treasuries of a similar duration. It offers a pickup of around 300 plus basis points. And also, if you compare it with other major bond segments, such as your Asian IG and global IG, the pickup is also pretty attractive as well. And fiscal dynamics across the major EMs here, they have also improved, while the rate pause and the narrative for potential rate cuts, it should also improve financial conditions, and that should support emerging market growth moving ahead. So in exchange for overweighting, bringing the allocation for EM bonds back up to neutral, we have further underweighted Asian high-yield bonds. So going forward, we continue to hold a negative view on Asian high-yield bonds, given our bearish view on China's macro story and its real estate sector in particular. So for China, we see little room for spread compression, as the risk will likely remain high. And at the same time, if you look at this chart over here, you can see that spreads for Asian high-yield bonds, they have compressed significantly already, and they are actually near their historical average. And we think that this is likely too optimistic, and it also discounts the risk of deteriorating Chinese property market and a slowdown in economic growth this year. So for our third change, we have equalized our value and growth allocations. So prior to this, our US and Euro equity exposure had a 70% allocation to value and a 30% allocation to growth. And as we start to turn more positive on the global economy, we have actually reallocated some exposure from our value funds to their growth counterparts. So now we hold a 50% allocation to value and also 50% allocation to growth funds within both the European and US equity exposure. And with our baseline view on inflation and interest rates staying higher for longer, we still see some merit in keeping value exposure across our portfolios, especially in the event that inflation it surprises to the upside or economic data comes in too strong and the Fed may be forced to keep rates high for longer or could even raise rates from here. So going forward, we also intend to look for more products with a quality focus to keep things in line with our outlook. Now, as I've mentioned earlier, I'll be sharing a few points from our outlook. I'll start with semiconductors. So semiconductors, they were initially a tactical allocation in our portfolios, but we have since decided to make it a permanent allocation alongside internet companies, given the huge and growing role that they play in the global economy. So together, internet companies and semiconductor companies, they form up the digital economy allocation in our portfolios. So for semiconductors, I would say that it is also one of the sectors that we are immensely positive on. And the core investment thesis driving our positive view for this sector is the rapid adoption of AI and the continuing digitalization of the world. So we believe that the semiconductor industry, it is once again at a pivotal turning point thanks to the rapid adoption of AI, which requires numerous highly advanced processors that are capable of handling complex workloads efficiently. And just like previous revolutions, as you can see from the chart on the right, such as your PC, mobile, and also the internet revolution, we do believe that the AI revolution, it will bring tremendous opportunities for chip makers over the next decade. And if you want to talk numbers, our estimate is for quarterly semiconductor sales to hit 40% year-over-year sales growth by the second quarter of 2025, which is the highest level over the past decade. And when this materializes, we also expect earnings for chip makers to soar along with their share prices. So more broadly speaking, aside from AI, as the world becomes increasingly digitalized, you have more smart devices going around, more semiconductor applications, and higher silicon content, it is going to drive a structural increase in semiconductor demand. Lastly, another important factor behind the growth of the global chip industry is the massive amount of support it receives from governments. So across the world, governments, they are handing out massive incentive to build fabs, adding to the total supply of semiconductors in the years to come. So over in the US, I'm sure you've heard of the Chips and Science Act, which promises over $280 billion in funding, and that is designed to boost American semiconductor R&D and manufacturing. And since this act was passed in August of 2022, several domestic chip makers, such as your Micron, Qualcomm, Global Foundries, they have all announced plans to increase their manufacturing capacity on US soil. And even your foreign chip makers, such as TSMC, they have also started to take advantage of the Chips and Science Act by building 2 plants in the state of Arizona, which it targets to be operational by the year 2025. So over in Europe, it also has a similar act, which aims to address semiconductor shortages and also to strengthen the continent's technological leadership. And over in Asia, China has made the development of its domestic semiconductor capabilities one of its biggest national priorities. And support from the central government, it becomes mainly from a state-backed fund, which has raised a combined total of $40 billion in the first 2 phases. So in September of last year, it was reported that fundraising for the 3rd phase has begun with another target of another $40 billion. And of course, China's efforts to build up its domestic semiconductor industry, it comes mainly from the pressure that the US and its allies have been putting on China in terms of the export restrictions and sanctions on selling advanced chips to China. So aside from China, another country in Asia, Japan, it is also ramping up its semiconductor capabilities. So Japanese chip makers, they actually once dominated the industry back in the 1970s and the 1980s. It is also starting to look for ways to regain its lost status as a semiconductor powerhouse. So to do that, the Japanese government has actually launched several initiatives that are geared towards attracting semiconductor investments on Japanese soil, and also to foster greater collaboration between its foreign and domestic chip makers. So I would say for semis, we are actually on the lookout to for opportunities to increase our allocation should valuations permit. Now, moving on, aside from semis, I'd like to share a little bit about big tech. So as mentioned earlier, we think that the earnings recession for big tech stocks is already behind us, and we do expect these companies to power the next leg of growth. So big tech stocks, they are also high quality companies as they display characteristics such as robust earnings growth, strong balance sheets, durable long-term profitability, so on and so forth. So many of these big tech companies, they also have unique competitive advantages such as pricing power, network effects, and also what we call a truly global business model, which allows them to earn revenue from every corner of the globe, ensuring that they are not affected by a downturn in any particular region. And contrary to popular belief, we think that big tech companies, they can still perform well in a higher for longer interest rate environment. And the reason for this is that it has extremely strong balance sheets. So many of these big tech companies, they are flushed with cash, they are cash rich. And being cash rich, it means that there is actually less need to borrow, and the cost of borrowing also it shouldn't be that high in a high interest rate environment given the kind of credit quality that you have. And on the flip side, many of these companies, they can also benefit from the high interest rate environment by investing their huge cash reserves, and that should build up their cash piles even further. Next, we also think that having a huge war chest also enables these firms to invest in R&D, and that should allow them to stay ahead of their competition. Cash, it also enables these firms to make acquisitions that should help them to access new markets or expand their customer base and ultimately defend their positions in this competitive landscape, something that small companies, they don't have the luxury of doing. Now, moving on, I'll touch a little bit on China. So China is actually our worst performing equity market in 2023, as you've seen in the first slide. So China's reopening rebound, we think that it is practically gone already. And for China, we have actually further reduced our Chinese allocation back in September of 2023. And this negative stance on China was actually adopted quite a long time ago, back in November of 2022. So in short, we think that China's economy, it still faces a lot of problems: fragile investor confidence, deflation, record youth unemployment, deterioration in US-China relations, property crisis, so on and so forth. And if you look at the dynamics of China, many businesses, they are also starting to pull money out of China, and not just money, they are also starting to relocate their operations, seeking to diversify their supply chains to other regions such as ASEAN or even its neighboring country, India. And if you look at how China has been dealing with this crisis, it has gone through multiple interventions by the government. Most recently, it includes roughly $280 billion US rescue package that was announced just last week. But even so, the stock markets went up for a bit and they continued to falter, and that just underscores how weak investor confidence is in China. So ultimately, we think that these measures, they are not sustainable unless China does something to actually change its fundamentals. And like I mentioned before, we think that China, it is in a structural decline, and in the absence of any significant reforms, any quick turnaround for China, it is going to be quite unlikely. Now, moving on. So after implementing all the changes that I have mentioned, here is our inter-asset allocation. So previously, like I said, we were underweight equities by 2.5%. So now we have increased our equity allocation by 2.5% across all our portfolios in exchange for a 2.5% underweight for our fixed income segment, which brings everything back to neutral. And for our equities intra-asset allocation, there are currently no changes. We haven't done any changes since September of last year. And for our fixed income allocation, the only changes that we have over here would be to increase our allocation to emerging market bonds by 2.5%. And this is actually funded from further underweight in Asian high yield bonds by 2.5% decrease. Yep. So yeah, this is just a snapshot of all the funds that we have in the growth portfolios across the conservative to the aggressive portfolios. So I'll just leave this here for you guys to have a look. And also on the final slide, it is our allocation to our income portfolios. So again, the difference between the growth and income portfolios, it is mainly the share class difference. So for the income portfolios, we as much as possible, we try to pick the share classes that distribute income, and that's how you receive your dividend payouts every quarter. Right. So that's all I have for today's presentations, and I'll be happy to take any questions that you have.
All right, thank you, De Jun. Feel free to send in your questions, and then we'll be on hand to help. All right, if you have any problems with writing down your question and Q&A, you can also type in the chat, and then we'll try to pick up from there. But of course, we would recommend and encourage you guys to type in the Q&A, whereby we'll be able to answer better. Well, I think there's a request to put up the last slide.
Okay, no problem.
Okay, so I think we shall wait a while. And
okay,
then,
maybe I can take a question during the meantime. I think there's a question on the expense ratio for each of the funds. Yeah, so for our portfolios, we have somewhere around 10 to 15 funds in each portfolio. So I don't actually remember all the expense ratios, but they should be in the range of around 1.5 to about 2.5%. So for the expense ratios for the funds, you have to look at the individual fact sheets.
then we are moving on to political issues.
Okay, there's a question on will the Gaza and the Red Sea conflict affect the economy? I think one of the most direct consequence of the conflict in the Red Sea is inflation. So right now, our view is for inflation to stay higher for longer. From the research that we have done, it shows that inflation, it doesn't just come back down magically to 2% in a straight line. It usually comes in waves. So sometimes inflation might come up, sometimes it might go down. So even though inflation in the US, for instance, has declined significantly from 9% to about 3-4% now, we think that it is still there's still some way to go. And on that note, even though the Fed has also said that they see good progress in inflation, and they think that in the coming months or coming quarters, they might be able to implement rate cuts, we don't think it's that straightforward. So if you recall, the Fed has been wrong before. In 2021, 2022, they were saying that inflation is transitory and they're not going to do anything about it. But then what happened? In the end, inflation shot up all the way to 9%, and they had to backtrack on their words and raise interest rates to the level that they were that they are today. So I don't think the issue on inflation, it is something that we can just put aside. I think inflation is still a very real threat. And speaking of inflation, which is why we have our natural resources allocation in the portfolios. So yeah, that will be our play to that will be how we implement this tactical view that inflation is going to stay high for longer. Okay, there's a question on, do we rebalance the portfolio every month? So the answer to that is no. We try not to rebalance every month. So the reason for that is because there are a lot of UTs, there are a lot of unit trusts inside the portfolios. So if we were to do rebalancing every month, most of the time will be spent outside of the market already. We won't be invested at all. So as much as possible, we try to limit rebalancing to every couple of months, and we try to implement the bulk of the changes at in one go. So, for instance, the last time that we did rebalancing was prior to this year was actually in September of 2023, where we implemented around 3 to 4 changes, including removing the Hang Seng Tech ETF, reducing China's allocation, initiating a core allocation for our digital economy products.
I think one interesting question will be about the India market.
Okay, so thoughts on the India market. I think for India, I think the main issue that we have with India right now is first of all, valuations are expensive. India is really expensive. So even though there are talks that companies are shifting their allocations out of shifting their operations out of China and into other regions like ASEAN and India, we think that India's valuations are too expensive for us to actually take a larger position in India. And on top of that, for India, I think the issue is India is not a technologically advanced country in terms of key technologies like AI, semiconductors. So for technologies like these, countries, markets like South Korea, Taiwan, US, Japan, they are more favorable. And given our favorable outlook for the semiconductor industry, we just don't think that India is in the right position, or it has the capabilities to capture this upswing at this point in time. Okay, there's a question on a recommendation for a China ETF to RSP in to benefit from this extremely low valuation. So I think it's no secret that we have a negative stance on China. Like I mentioned, we have taken this negative stance since November of 2022. And initially, when my colleague at the time, when he initiated this position, I think there was quite a bit of pushback, given that we have been positive on China for many years already. And I think even though there were ups and downs since that point in time, I think if you look from end 2022 until today, China has been is in the red. So I think on hindsight, it was a good decision to underweight China. So our current stance on China is that if you still want to invest in China, what we recommend you to do is to invest in companies or the sectors that are in line with the government priorities. So one of these sectors, for instance, is semiconductors. Like I mentioned earlier, Chinese semiconductors, they are under a lot of pressure to quickly get their technology up to date and compete with countries like South Korea, US, and also like Taiwan, for instance. So this is an area that is heavily favored by the government. I think the government will be willing to burn a lot of cash to build up its semiconductor capabilities. So we think that investing in sectors that are supported by the government, it should be something to look out for. And aside from that, I think for A shares, you also can look at some of the A share unit trusts or ETFs. I think A shares, they are more in line with the government's objectives as well. I think for the tech sector, it's going to be quite difficult for the tech sector to see a significant rebound. I think investor confidence in Chinese tech has just disappeared after the crackdowns, after the many crackdowns across these few years. So I think just recently it was announced that they were coming out with a new set of regulations to curb gaming addiction in China, and that led to a sharp decline in Chinese video gaming stocks like Tencent, NetEase, so on and so forth. So I think China is a market where the government tends to take a very heavy-handed approach when it comes to regulation, and overnight it can just ruin entire industries. So case in point would be the edtech sector, where where one announcement from the government led share prices drop by 90% in the next day. Okay, there's a question that FSM has just upgraded South Korea to 4 stars, very attractive given the semiconductors outlook. Is there reason not to include Korea fund, at least in a more aggressive end of MAPS? Okay, so if you look at our asset allocation, so if you look at our equities intra-asset allocation over here, there is no allocation, there's no standalone allocation to Korea. And that's because Korea is still a relatively small market in the grand scheme of things. So our allocation to Korea actually comes from our Asia X Japan funds. So out of the 3 funds that we have chosen, I think one of them, they have a slightly higher allocation to markets like Korea and Taiwan, and slightly less to markets like China. So I think this is something that we'll be looking to implement going forward. So we are looking to change. We are speaking to the fund managers now to understand their stance on China, and if they are going to continue overweighting China, then we'll have to look for alternative funds already. Yep. So speaking of changes like this, I also want to share a few changes that I forgot to mention earlier. So aside from the changes that I have mentioned that we completed in January, maybe I'll just share a couple of things that my colleagues and I are thinking about. So one of it is to look for funds with a quality focus. As I've shared earlier, I think quality stocks, it is something that all investors should look out for in the current investment environment where interest rates are high, growth is slowing down. I think quality companies, those with strong balance sheets, robust earnings, and most importantly, sustainable business models, they can tide through tough times like this and also can do well in most environments. So so we might be making a couple of fund changes. And another change that we are thinking about is to remove our China allocation. So our China allocation, like I shared, it is around 11%. So that comes from our allocation from the core China sleeve, and also you add that together with the China allocation that comes from the Asia X Japan sleeve. We still think 10% it is a little too high, and we will continue to underweight China and reallocate to markets that we are more positive on, perhaps like Japan or US if valuations allow. So speaking of high valuations, after we initiated the position on the digital economy in terms of the Invesco Nasdaq ETF, which is the PNQI, and also the VanEck Semiconductor ETF, I think these 2 ETFs, they have done pretty well for us over the past quarter or so. And the team is also actually looking for an opportunity to increase this allocation further. And that would depend on valuations again. So even though share prices have gone up significantly, I think we won't rule out increasing allocation to these 2 markets as long as we can justify the earnings growth.
I think one question will be why is the equity intra allocation so different from the MSCI World Index?
Okay, so the reason for that is MSCI World Index, it goes on a market cap weighted allocation. So because of that, the US market has around 62% in the MSCI AC World Index. So our portfolios, they when they were incepted back in 2016, they were created with a GDP weighted methodology. So that explains the difference in the equities, the geographical market allocations. Okay, there's a question on will you be bullish on SPY and AI ETFs? So SPY, I assume you're referring to the S&P 500 ETF. I think for our view on US is that, number one, valuations are high. However, growth is, the economy is more resilient than one might expect. And because of that, we are going to be selective when it comes to our US exposure. We are going to favor high quality companies. We are also going to favor sectors that can deliver strong earnings growth over the next few years and multiple expansion. So the 2 sectors that I mentioned, digital economy, your internet companies, and your semiconductor stocks. So these are the two segments that we are keeping a close eye on.
All right. Thank you. Thank you, De Jun, for the sharing. So also a big thank you to everyone here who is with us this evening. And we also thank you very much for all the questions that you came along. If you have any other questions that you would like to ask, you can drop us an email at clienthelp@𝗠𝘆𝘀. On the screens are the links to our social channels. Feel free to scan the QR code of the channels that you use often, and we will love to see you at our social channels also. And so with that, the webinar has ended, and I'll leave this screen up for a few more seconds or so, and have a good evening, everybody.